We are live for whenever we're ready.
Okay, do we have a quorum yet, Susan?
Yeah, we could get started. I think Christina's here, so we do have one of the co-chairs, and Sheila's coming in, so we'll have 5.
Okay,
Louis should be coming in pretty soon. He just texted.
Okay, good. Yeah, and Justin did send me a message as well, so hopefully he'll be joining.
Hi, Sue. This is Christina. I'd like to call the meeting to order for what's today, June 16th, and Public School Retirement System Investment meeting. Can I get a roll call, please?
Angela Banks, Christina Bennett,
Present.
Louis Cross, Sheila Goodwin,
Present.
several people coming in now. Donna Jones, Yvette Levy. Here. Martell Mann. Bobby Richardson,
present.
Albert Sanders, Justin Stein,
Present.
Doris Walker,
Present.
I'll go back, Louis Cross,
Present.
Martell Mann.
Present.
All right, so we have enough, we have 8. So we do have a quorum.
Thank you, Stu. Can we proceed with the agenda?
Before, I know Gwelda and Jeff, you have a lot of things to talk about tonight, but we did have one issue that we just needed to address quickly, and that is changing the regular Board of Trustees meeting from the 20th to the 23rd. So I'm going to put that motion up, and if we could maybe do that first, and then we can proceed with the agenda.
Louis, can you proceed?
Okay, so it's at number 1 item.
Can I get a motion to change the regular board meeting date as presented?
Okay, I would like to change the regular board meeting date to change the June regular board of trustee meeting to Thursday, June the 23rd, 2022.
Sheila
Second.
Goodwin, second.
Been properly moved and seconded. Any discussion? Hearing none. Sue, I believe we need a roll call vote.
Christina Bennett,
Yes.
Louis Cross,
Yes.
Sheila Goodwin,
Yes.
Yvette Levy,
Yes.
Martell Mann,
Yes.
Bobby Richardson,
Yes,
Justin Stein,
Yes.
Doris Walker.
Yes.
Okay, so again, we have 8, motion carries. So thank you very much. All right, so Jeff and Gwilda, floor is yours. Where would you like to start?
I think the investment guidelines are showing on the agenda as first.
Sue, do you want to pop that up and scroll, or do you want me to share? How do you want to do that?
Yeah, I have it here.
Okay. Okay, great. Good afternoon, everyone.
Good afternoon.
Good afternoon, Jeff.
So hopefully this won't end up being as onerous as it might look, just with everything marked up here. But because a lot of it is just some, for the most part, some minor modifications to language, and certainly the bulk of what we're going to see in this when we get towards the end of the document is that it's more of a recognition of changing some of the items that we had proposed for the portfolio structure. So all of that will get reflected in the asset allocation tables and the ranges and benchmark tables and everything else in the back. So we'll go over that when we get there. And again, some of these other things are probably more minor language type issues. And then we did see a couple of sections in here that referred to performance objectives and how to monitor managers, and we saw some sections that were missing, so those were added as well. So we'll go through these and try to explain what's most substantive. So on the first page, you see just a minor change that when we referred to the universes, because again, what we found is different consultants might use different universes, and I know that's something that was previously spelled out in the back, the universe that's being used. And what we've also seen over the past several years is that some of these universe providers, they merge and then the names change and things are different. So wherever possible in these investment policies and these guidelines, we try to be where we can be generic and sort of, and if that's appropriate, we like to be generic, and then other areas where we think things do need to be more specifically spelled out, we'll do that as well. But you'll see that's kind of a theme as we go through some of these things, that there are probably some areas that we genericized a little bit, and that's just to recognize that in particular, if a universe provider changes or if a benchmark for a certain strategy changes, that all we're really having to update then are the appendix tables, as opposed to having to update more things in the body of the investment policy. So again, I'll point those out as we get to those. So that's one thing that we did with the public fund universe, is just to say, let's just make sure we're talking about the appropriate third-party public fund universe. So the next page, again, is a little bit of a wording. Or I don't know, Sue, can you scroll down a little bit? Because I'm not sure if there's anything else on the first page there.
Oh, yeah, a little bit.
Okay. Okay, so again, this is just more of, again, as I mentioned before, let's push anything that we're specifically spelling out as far as indices and universes to the appendix, where that can be spelled out and that can be updated and changed as necessary, and pull it out of the main body. So that's essentially what we're doing here with the equity managers, taking out the specific mention of the S&P, and in the universes, also the same thing for the international managers right below that. And then Sue, if you want to scroll, Sue, I don't know, maybe if it makes sense to zoom this up so we're just getting one page per.
Okay, let me do that real quick. If you want to kind of talk through this, I'll do that in Word, because this came through as a Word document. So.
Oh, okay, gotcha.
All
Now,
right, excuse me a minute here. I'm getting this thing clarified, and I got to do this in piece by piece. So on the first page where we're talking about equity managers, you want to change the term fund universe? Is that what we're saying here?
No,
What, one second here. So,
Sheila, what you have to read is you have to go back to the appendix 3. And what they did is they removed,
Appendix 3?
yeah, they removed the very specific indices, and then and so if you update any managers or whatnot, then all you have to do is update the appendix, not the full document. So they just basically, that's why you're seeing a lot of red, is basically they changed, they were a little more specific to our exact managers on the appendix. So so that's what you see.
right.
Is you have to read appendix 3 with all these changes.
Oh, wait a minute. Oh, wait. Getting clarification here. All right. I'm on a page that has the performance objectives. Okay. And then we came down to the section of the equity managers. That's in section D.
Yes.
All right. Now in section D, are any changes gonna be made in 1 and 2?
Yeah, so again, how to interpret what we're looking at here. Yeah, and again, because I understand that this is messy, but anything that you see that is black in text is existing text, and then anything that you see, it would be in this section it's a blue color, and other sections it might be red, and that change is just based on who's editing it. But if you see a striked line through text, that means that is text that we are deleting. So if you see where it, so let me give you an example here. So let's read D number 1. So total return for domestic equity specialist managers shall meet or exceed the Standard & Poor's 500 index. So we would say strike the language that says Standard & Poor's 500 index. So it would read, total return for domestic equity specialist managers shall meet or exceed an appropriate index based on the manager's style and consistently rank in the top half of the investment consultant's appropriate fund universe as outlined in Appendix 3. So that's sort of how to read it. So if you see, and again, it looks kind of messy, and I apologize, but this is sort of standard for how we edit a document for everybody to understand the changes that we're making. But if it's got a line through it, that's language we're striking. If it's a shaded, if it's a different color text and it doesn't have the line through it, like where it says as outlined in Appendix 3, that's language that we're adding to the text.
Okay, as
That-
outlined. Wait a minute. So see, the blues is confusing me. We striking out domestic equity specialists, and we're leaving in fund universe as outlined in Appendix 3.
Correct.
Okay. So yeah, you're right. It's messy because we got too many blues here. Okay, go ahead.
Yeah,
So Sheila-
and again, once everybody sort of sees what we've struck and then what we've added, the process is then we clean it up so you don't see that. But why we do this is just to make sure you know what has
The
changed.
old and the new. I got you.
Right, exactly. So this is sort of, as messy as it might be, this is sort of the best way to see what is being changed. Because otherwise, if we just gave you a clean copy that had all the changes, you'd say, hey, what changed?
Got it.
Yes. And what's being more specific is that this says, for example, Sheila, number 1, the S&P Standard Poor's Stock Index, right? Well, if you looked at appendix, page 17, appendix 3, there's only one that we had that was S&P. So they made it very specific to the manager and to what index we're going to benchmark them to. So they were a little more detailed, and they updated the document to bring it in line with what we actually, our benchmarks that we actually use per manager.
Okay.
Thank you, Christina. Okay, so down to page 2, again, we've just, for the emerging market manager, we genericized that and just added that the total return is what we're looking at. So again, just trying to be a little bit more specific on what we're evaluating here. And then right below that, again, there was no reference to how we were measuring the total return manager, or sorry, not the global equity manager. So that's what's added in number 4 on page 2. And as we scrolled, if you want to scroll down to the next page, Sue, page 3. And again, we did the similar process for the fixed income managers. So took away the specific mention of the benchmarks, and then are referring everyone to review Appendix 3. And again, number 2 was a little bit not fully encompassing all of the different fixed income managers that the plan is currently using. So that's what number 2 here does under this section, is just adds the mention of the additional specialist fixed income managers that are employed. F, in real estate, again, we took out the specific mention of the benchmark and referred again to Appendix 3. G, the previous version did not have any, this is G and H. There was no mention of how global asset allocation or hedge fund managers were evaluated. So again, we wanted to add that to these sections. And moving down to I, and why the market neutral and the hedge funds were lumped in there, that wasn't quite clear. So we're really making that encapsulated in the previous section. So this is referring to the private market investments minus the hedge funds. And what we did want to add on this is that we should be comparing the private market investments based on internal rates of return. So those are a little different measurements than what our other liquid managers we're looking at. So where we might have periodic quarterly and monthly and quarterly and annual returns based on more frequent market values and valuations. We don't get the valuations as often, and also those valuations tend to be much lumpier, so we have to measure those in a different format. So we do that in our report through these specific charts that are called internal rate of return charts, and they take into account those lumpy cash flows and the different timing that the private investments might have, and how they look from a liquidity perspective relative to other investments. So again, that's important, and we just wanted to make sure that was spelled out in the policy that is going to be a method for how we should be evaluating those investments. And then the next section that refers to a public market equivalent. So that's another measurement. And again, because it's kind of hard to make apples to apples comparisons between different types of private equity strategies, and certainly from whenever a private equity investment starts, their rates of return and those internal rates of return that I just talked about can be very different. So another component that we can use, and then we'll have in the reports, is called a public market benchmark equivalent. And really all that's doing is saying, if we use the same cash flow pattern for one of your private market investments and applied that lumpy cash flow pattern to an appropriate benchmark, such a market benchmark such as the Russell 2000, which is a small cap equity benchmark, how would that equate? So what would the equivalent or Russell 2000 internal rate of return be, if the Russell 2000 was a private investment. So it gives us just another apples to apples comparison to take a look at some of these private market investments. So again, probably not going to be as clear when you see this in writing here, but what we will do is when we go over the next quarterly report, we will spend some time on that and take a look at how we're measuring the private investments, and then we can talk about those concepts, the internal rate of return and the private market equivalent benchmarks. So those will be much more clear when we take a look at the quarterly report. So Sue, if you want to scroll down to page 4, and this starts the asset allocation section. So in the asset allocation section, no changes in section. Sorry, let me jump up. I'm lost track here.
Asset allocation.
Okay, sorry. Section, so it was the Roman numeral 3, that's asset allocation policy. We didn't change any of that language. Roman numeral 4, we added, and that's on page 4, and that's rebalancing. So again, this wasn't addressed in the previous policy, so this is an addition, and this just says there is a methodology for rebalancing within the plan that this investment program does have investment policy targets and ranges, and we do spell those out in the back of the policy, but there is a methodology for rebalancing, and that starts number 1 with any ongoing cash flows for benefit payments and expenses that are needed on a monthly basis. And then outside of that, there's a process for evaluating those allocation targets and where we are relative to those targets and ranges on a quarterly basis. And if we're falling outside of those ranges, that we do have the duty to go back and do a rebalancing that gets us within those ranges that are outlined. And again, that's a chart that we have added to the performance report, and the past several reports, Gwelda has gone through those, and that's that chart right up front. We think it's very important that you see what your asset allocation is, your current allocations, what your policy targets are, what those ranges are, and then we have those little triangles that tell us if we're in compliance. So that's our very, I guess, easy and executive summary way to look at that and to make sure that we're complying and doing what we're saying here in section 4. So now, because we added a section, the section on investment guidelines now becomes Roman numeral 5 on the rest of the page, and no substantive changes to any of those sections through 5C. If we scroll down to page 5, again, no changes to 2 and 3. 4, let's spend a couple of seconds on this because this is a fairly material change in that we were previously spelling out for the fixed income managers that they had a maximum duration of 7 years, and a duration, that's just a measure of risk that tells us in the world of fixed income, duration means how sensitive a fixed income portfolio is to short-term changes in interest rates. So, and this is a pretty important environment for that today, because as we've seen, the Federal Reserve has been raising interest rates, and so those rates have been going up. And again, why is that a risk or a risk factor that we need to monitor? Because for a fixed income portfolio, this is how the relationship works. When interest rates are going up, short term, the value of bonds is going down. So that's a risk. Now, alternatively, when interest rates are going down, value of bonds are going up. And a duration is a way to measure that sensitivity. So to think about how that works, the higher or longer a duration, the more sensitive a fixed income manager's portfolio will be to those short-term interest rate changes. So why do we give the managers a limit here? Well, because we want to limit their sensitivity to those short-term interest rate changes. Now, what happened here is historically, this policy gave the fixed income managers a 7-year limit. And that was, if we went back several years and looked at the interest rate environment, and particularly what was that duration or maturity factor for the benchmark, well, it was probably around 7 years. But as interest rates came down in the past couple of years, that duration has changed. And so that's sort of the risk here, is that you can also have environments where interest rates are going up, and those durations can ultimately, depending on the portfolio makeup, that benchmark duration can be longer. And so actually over the past couple of years, the Barclays aggregate, which is the primary fixed income benchmark, actually had a duration that was at 7 years, and sometimes has been even longer than that. So we've sort of told our managers, well, you can't have a risk exposure or a duration exposure that's as high as your benchmark. And so that can be limiting to their performance. So generally what we've done with policies is, rather than giving a specific number like 7 years, we like to give a relative range around what the benchmark's duration is. So that's what we've done here, is said your active managers should maintain a duration that ranges from 75% of the benchmark duration to 125% of the benchmark duration. So that way, they're not taking on significantly more risk than the benchmark, but they're allowed to stay in check with where the benchmark might be if that duration level goes up or down. And alternatively, they're not going too far below that. So that's a bit more of I'd say a substantive change here. But, and also just to let you know, this was something that we initially saw this, and Gwelda and I talked about it and said we probably need to make that, or think about making that, a relative range. And then at that same time, we also received a call from Exponents, and they mentioned it as well. They said we're running into trouble with this because we're trying to keep our portfolios duration right around where the benchmark is, but it's that their benchmark duration is a little higher than 7 years now. And so we are constrained. So they asked us also to take a look at this change. I'll pause for questions on that, because I know that one can be a little bit more involved.
I had a question on that one. Definitely, because we went from 5 years, then we went to 7 years, but I guess the trend with today, I haven't seen any others, but I just questioned, if this is what the market is doing versus this is what our managers are asking for.
Right. No, I would tell you, and Gwelda, you can chime in as well and correct me if I'm wrong on this, but generally, all of the investment policies that I've been revising over the past several years have gone towards this relative change. And so it's driven by us, it's driven by the industry, and certainly, and it's not to say managers don't, the managers certainly do have input on it. And this is really done in conjunction with the entire universe of managers that are seeing the same thing. If we are measuring them relative to a specific benchmark, but they're not allowed to structure their portfolio in line with where a benchmark is, it can be a significant limiter for them. So
it just makes more sense for you to use a relative, so that when that duration changes for the benchmark, the manager is in line, rather than saying this set number and things may change and then you're out of whack, the manager's out of compliance. So, it makes more sense to do it relative to whatever they're being benched against. That's why we made that change, depending on what's going on with that benchmark.
does that help, Christina? Okay, down to number 5 again, just a couple of small wording changes. We just wanted to add prudent diversification within this section, and then also just making it clear that diversification structure of securities, quality sector is at the discretion of the manager. So that's not a decision where you as a board of trustees are not telling specifically telling the managers how they need to diversify their portfolios, or you were just telling them they need to be prudent in that effort, but it's at their discretion. The international equity managers on the section D, number 1, just wanted to add, number 1, it refers to international managers. We just wanted to clarify that that's equity managers within this section. And it does talk about their use of currency programs, which is pretty standard for a lot of international equity managers. They may hedge currency positions within their portfolio. But we just wanted to clarify that at least in the construct for our traditional international equity managers, that really that's for straightforward currency hedging and is not really on as a way to add additional risk exposure to the portfolio. And in particular, we wanted to make sure it's spelled out that they shouldn't be using leverage to employ that currency exposure. Down to number 3 in that section, again, just adding some additional language on prudent diversification of the portfolios.
We should correct that. There was a misspelling there. Typo.
Oh, yeah, you're right. It's underlined red there. That's misspelled. Okay, scrolling down to page 6. And again, this is a change we made, and this is more due to how things have been classified within the portfolio and trying to reclassify. Because I think if we went back historically, we had a global bond manager, probably added another more or less global bond manager that might be doing similar things, but called it something else. So there's a number of different managers that can really fall within this category. And also we wanted to encompass the other strategies in the portfolio, such as the emerging markets and tips and anything else that might be a specialist strategy. So we wanted to change that section to really encompass all of that. So we changed all of that to opportunistic bond managers. And now this entire section can refer to any of those managers that really we wouldn't call U.S. domestic core managers, which is really encapsulated in the previous section. So again, we spell that out and say what are those types of strategies. So could be opportunistic global managers, emerging markets, tips, and absolute return funds. And again, in 3, just changing some language there to denote prudent diversification. And again, most of these other changes are just going to be changing the word global to opportunistic to encapsulate all of the managers that fall within that section. And then on number 6, we changed that language again to not only refer their benchmark to Appendix 3, but also incorporating that same language. So here we had again, a diversification constraint that was, or sorry, we had a duration constraint that was at 2 years for these managers. And again, because a lot of these managers within this global and this opportunistic segment are doing different things and have different benchmarks, we wanted to change that to a relative. So again, we're saying 75% to 125% relative to each manager's specific benchmark. And again, those benchmarks will be outlined in Appendix 3. So section F, no changes to the language on the global allocation managers. Section G is private markets, and that'll take us down to page 7. Sue, if you want to scroll down again for the first couple of sections here, no changes all the way down to 5. Again, just adding the word prudent in front of diversification. Jumping down to section 8. Again, we wanted to spell out just where money would be coming from for capital calls within these alternative investments. So again, we added a little bit more language to clarify here that said all the reserves for any alternative investments may be held in the liquid asset classes in compliance with the asset allocation policy and ranges. So that's just to say when we are waiting for capital calls in private markets or other areas of the market where those segments might be a bit below their policies, we, according to the rest of the in-place policy for other asset classes, that's where we will keep that, keep any of that excess capital in reserve. And alternatively, when private managers come back and they are calling capital, we will look to take capital from the other asset classes in compliance with policy. So in order to keep us in check with the policy. And again, that's an exercise that if we go back to the last meeting when we talked about the policy and rebalancing, so that's an ongoing process that we'll look to go with. Okay, section H is hedge funds, and we changed this to include. I'm getting a pretty bad.
Yeah, you're getting a back feed, Jeff, for some reason.
Maybe if everyone can go on mute.
There you go, better.
It stopped, so whoever it was, I think muted. Thank you very much. Okay, the next section, we just added hedge. The section was hedge fund of funds, but you technically have a hedge fund investment that is a single strategy, and it's not a fund of funds. That's white box. So we just wanted to spell out that the section incorporates hedge funds and fund of funds. Okay, and then number 3 in this section, we did want to clarify on leverage, because within a fund of funds, they may be investing in underlying hedge fund managers that might employ leverage, and we can't really dictate that to the fund of funds manager. So that's at their discretion whether or not their underlying managers are employing leverage, and that's pretty standard for a lot of hedge funds and fund of fund structures. However, what we are restricting here is that the fund of funds at the global level, they are not allowed to employ additional leverage at their fund of funds level. So that would, again, just create additional risk for the portfolio. So that we are restricting. And again, that's fairly standard for fund of funds investments. And we're not, while some may have structures that do that, we are not allowing that. And then scrolling down to page 8, and this now gets into real estate managers. Again, no major substantive changes, just adding prudent and diversification again within those portfolios. Same thing with the general guidelines for all managers. Again, just wanted to add prudent under diversification. And then section 4 that we added here, and this is kind of important because the guidelines and restrictions that we spell out within the bulk of this document, a lot of that is really going to refer or only be applicable to your separate account managers. So those are managers that we can give them specific guidelines, and they're managing a separate portfolio directly for the system, and they can follow those guidelines. However, the system also has a number of investments in products that are commingled funds. So you're invested alongside a lot of other investors within that program. And for any commingled fund, whether it's a common trust fund or whether it's a mutual fund, because it's commingled and there's all sorts of other investors in there alongside of the system, we really don't have the ability to make them abide by or change their portfolio based on a lot of those other specific guidelines. So, but however, they do operate by their own guidelines, which will come through a private offering memorandum or a prospectus for a mutual fund. So again, they have very specific guidelines in writing, and we have those documented. And what we wanted to spell out there is that the system may and does invest in pooled funds or mutual funds, and those mutual funds are really beholden to their own set of guidelines and restrictions. And that's really, we just wanted to make sure that that was spelled out here to say that we understand that they have their own separate guidelines, and we know that the managers are required to hold up to those specific guidelines. I'm echoing
Jeff, this
again.
is
It's throwing me
Christina. I
off.
have a question.
I'm echoing again. It's throwing me off.
It's me. It's Christina. I'm in the car.
Okay.
So I have a question on that for commingled versus wrap accounts. So we used to do a lot of just straight up separate accounts.
Right.
And probably for the last 10 years, NEPC has really put us in a lot of commingled funds. And so what is your thought on that percentage ratio, or does that matter for us when we need to pull cash in a down market? Does the mix of separate accounts and commingled funds impact our ability to pull cash in a down market?
So I would tell you that right now I would say no, it doesn't, but that is something that we certainly pay attention to. And that's that. So if you think about the reasons that we would be investing in a commingled trust or a mutual fund, what are the reasons? Well, the one would be that's the only vehicle that a manager offers. So if you think about a lot of the private investments, that might be the only way you can access their investment. So they won't do a separate account for you. So that would be one reason. Another would be size and fees. So some strategies might have very high minimums to have a separate account. And if we don't meet those minimums, we would have to go into a commingled fund. But ultimately, and how we look at managed accounts is that if you're a plan that's of the size that can get a separately managed portfolio, and the fee on the separately managed portfolio is better than a commingled fund, that's when we're always going to recommend the separate account. Now, if the only way you can get access to a strategy because either separate accounts aren't offered or you don't meet minimums, or in some instances, you might even have a commingled vehicle that ends up being less expensive. This is rare, but it does happen. A commingled vehicle that's less expensive than a managed account, then it would be preferred or recommended. Now, let's go back to your liquidity question, because it's a great question. That's certainly something that we evaluate when we look at the plan and say, well, number one, if we're going to go into a commingled vehicle, let's always figure out what the liquidity is. And let's always prefer that it's number one, if it's a daily liquidity vehicle, that's the preference. The second preference in any sort of commingled vehicle would be monthly liquidity. And then when we start to go to quarterlies and longer, then we're talking about hedge fund structures, real estate structures, and private equity. And that's where, if you take a look at when we did our asset allocation study and our portfolio structure study, we pay certain attention to that, and that we don't want the overall liquidity of the portfolio to be limited. So when we say, well, we only have a 7% target allocation to private investments, or a 6% or a 5% to real estate, or whatever our percentages are today that we're approving, that we're definitely making sure we pay attention to liquidity when we have those guidelines. And so understanding that we could be in a tough market environment like we are now, and we do need to have liquid places to go to. That's why we don't want to have 20, 30, 40% in lesser liquid vehicles. So I would tell you right now, no, we're not concerned with the ratio that we have today. We think we have plenty of pockets of liquidity to get what we need today. But also we'll tell you that anytime that we do look at the appropriate investment vehicle to be used, separate account versus commingled fund versus mutual fund, that's always what we're looking at. We're looking at what the liquidity is, what the fees are, and how that strategy might stay in line with the overall composites.
So my question is, what is our percentage of commingled versus wrap account or separate accounts? Because that is something I would always ask any PC, that our percentage of commingled was pretty high, but I wasn't, I didn't make the correlation to the down market and the ability to get cash out, and where should that number be?
Right, and again, we don't have we can do that specific calculation for you. I don't have it at the tip of our fingers right now. And when Gwelda's going over the report, I can sort of back of the envelope, or if she wants to try and do a back of the envelope while I'm going through the rest of this, we can do that. But so we'll give you a specific number, and then I think we can tell you, because it's not. The important thing is not to say what is the ratio of commingled funds versus managed accounts, but I think what's more important is to say what are our specific liquidity buckets. So again, because I would say that we would look at a daily traded commingled fund or a daily traded mutual fund as having the same liquidity as a managed account, and sometimes even better, because I think if you look at a mutual fund is a great example, that they're only daily traded, but we're going to get the money the next day. For a separately managed account, we can certainly tell a separate account manager to get us the money the next day, but we might be hard pressing them to do that. So they might have to do some pressured selling. So generally when we want money from a separate account manager, we usually want to give them some lead time. In a lot of cases, we might want to give them at least a week to liquidate what we need from their portfolio, so they're not having major market impact by liquidating for us. So that's sort of something we pay attention to. But I think that's the better way to look at it. And again, we can do this. We can create a table that says, here are all your investments, and here you have daily, weekly, monthly, quarterly, or longer. So we can outline it that way, and then you can see it in percentage terms of exactly what percentage of the portfolio is daily, what is weekly. And again, I would say when I use the term weekly, I generally put managed accounts or separate accounts into the weekly category, because I think that while it is technically daily and we can request a separate account manager to get us that money the next day, in order to keep them from having to upend their portfolio and incur transaction trading costs and market impact, that we like to give them some time. Does that make sense, Christina? And again, we'll make a note, and we can put that table together for the liquidity percentages.
Yeah. I'm gonna turn off my air in my car because it gives background noise. Now the question that I didn't see in here in any of this is that whether it's private equity markets or whatnot, that our attorney wants us to have, or to try to get a side letter with each investment manager that may or may not coincide with what the standard industry does. And it's kind of like that they're going to abide by every single one of our guidelines. So you know the letter I'm talking about, that sometimes some of our private equity managers will not sign it, but it's not in here in this document anywhere.
Yeah, well, and again, I think that's really, I think that's sort of what we're trying to encompass in section 4 on this page, is to say that any of the commingled funds, and that would include, I mean, and we can spell out that that includes the private equity managers as well, but they have their own operating memoranda and private placement agreements that have their own specific set of operating guidelines in them, and that's what we know that they will be beholden to. And again, that's why we wanted to clarify, because, and as you said, Christina, you can give a private manager that has their own prospectus or operating guidelines, you can give them our guidelines and say, we want you to abide by them. And a large percentage of them are going to come back and say, we can't, because they have other investors in the portfolio and they have to keep everybody, and they can't change their own internal operating guidelines to match ours. So that's why I think section 4 here is important, because it does spell that out. And as far as what the attorney has requested, and what we've seen from other private investment is they might be willing to do letters of understanding or letters of clarification that just say, again, your manager XYZ, your document doesn't say you would act as a fiduciary. We want you to spell that out, or other things that might be along those lines. They're letters of clarification or letters of understanding. And they will sign those as long as those don't conflict with anything that's in their operating guidelines.
And also to piggyback on that, if the side letter language is something that, or something within their documentation that the board is very opposed to, and they won't agree to something that you really want, it's your decision at that point as a group to not invest if it's unacceptable. So you always have that option. But if you're already in it, if you've already signed off on it, then that's kind of, the door's been closed.
Yeah, and the issue is that that when we go into these investments, we make recommendations, we go through the entire process. And, I've never seen one of these letters, but some of our managers have been hesitant to sign it. And then we have to come back to a board and say, yes, we're going to continue because we don't think that, that again, our little 5 million can change a $800 million fund, right? Guidelines. And so, I just don't want to get exceptions every time we go into these markets, and we know we want to enter into certain investments, but then, we've got to make an exception for the documentation.
Well, the way that we've operated with respect to privates, with the other accounts that I work on, is the research analyst gets the documentation, and we dissect it as well as send it to the attorney before we make the recommendation to the committee. And so the side letter language and all that is taken care of before we would bring it to you at the committee level. And we'll have already gotten the opinion of the attorney rather than backwards in presenting it to you and then getting an opinion. Typically, we get in front of that so that you don't have these kind of issues. And then you have the decision based upon our research assessment as well as your attorney, whether or not we want to present it to you. If it's totally unacceptable, we won't present it. Now, what you're already in, we can't go back and change that. But
no, we're not asking that. I'm just saying I like your forward thinking process, and I like your forward thinking process. Thank you.
Okay.
Okay, so moving down to Roman numeral 5, we just added expenses in there, so benefit payments and expenses, because that's also what cash is being used for. So minor clarification. Section Roman numeral 6, standards of investment performance. That'll scroll us down to the next page, page 9. and no changes in the first couple of sections, no changes on the watch list or probation section. Reporting requirements, Roman numeral 8, no changes there. And then that'll take us down to page 10. Again, here, no changes on any of these sections. All the way through to number 6, and that'll take us over to the next page, page 11. No changes through C 1 and 2, and that will take us all the way down to page 12, where again we have no changes. So we've put Sue's name in there. Okay, and now jumping down to page 13, and this is gonna get a little bit messy again, but so these are now the appendix tables, and after we've made a lot of those substantive changes in the body of the report, and a lot of that is now referring us back to these appendices. On a go-forward basis, this is really what we would expect where we might have future changes. So anytime that we do, we revisit the asset allocation studies and portfolio structure reviews, and we change any of those target allocations, that will be reflected here. So again, this is the target allocations by major asset class. And again, while this looks a little messy, what we previously had was a structure for benchmarking US equity that really didn't seem like it was fully reflective of the actual structure. So based on what we recommended at the last meeting and the committee approved as far as the structure, that's going to be a US equity structure that puts us more in line with the total US stock market, which is what we would measure to be the Russell 3000 index. So that's how we would recommend evaluating the US equity piece. And then you can see that US equities we've put all together at 28% of the portfolio. Again, that was as recommended at the last meeting. International equity at 15% of the portfolio, and there we're recommending measurement against the MSCI All Country World ex-US as opposed to the EFA. And again, that's a more encompassing, a more diversified index structure that better represents the total portfolio for international managers that the system is invested in. Global, we put that under equities, and that's no change in that allocation. That's 5%, and it's the same benchmark. Global asset allocation, again, this is something we took a look at this section and then next couple of sections, and again, all of these percentages that you see on the left portion are going to match up with what we recommended at the last meeting in the portfolio structure, but we do have some changes with respect to benchmarks. So again, we looked at some of the existing benchmarks and thought there would be better representations for a number of these categories. So again, for the global asset allocation managers, they are in equities across the world, US and international, and they're in bonds across the world. So finding a more diversified, all-encompassing index to measure those managers against would make more sense, be more appropriate here. So that would be a 60% mix of the MSCI World Equity Index, and then a 40% Bloomberg Barclays Multiverse, which again, that's a global universe of fixed income. So going down to fixed income, again, we wrapped really everything up into one portfolio structure, really matching how we have outlined and what we've recommended to the committee for a fixed income structure. So again, the total allocation would be 25%, And due to how we're structured in a very diversified nature with having the core piece and then the smaller opportunistic manager pieces that are on a satellite there, all of that aggregates to give us what we would say is something that should perform in line with that Bloomberg Barclays multiverse benchmark. So that's how we're looking at fixed income and recommending that that's how we evaluate on a go-forward basis. The hedge funds, again, no change in the target allocation, but we are recommending that the fund of funds composite, HFRI fund of funds composite, be used rather than that HFN multi-strategy. Again, the bulk of your exposure is going to be in fund of funds, and even your multi-strategy manager white box is probably going to have characteristics that are a little bit more akin to a fund of funds. So if you look at all of the hedge funds together, probably the best way to measure is going to be relative to that fund of funds composite. The real estate, again, we specify the NCREIF ODC. That's an index of other commingled real estate managers, and that's going to be a better index to look at versus just that NCREIF property index. So those are direct properties. A lot of those in that NCREIF property index can't be directly accessed by your managers. The pricing on that can be a little bit stale. So again, we like that ODC index because it's other like managers that are similar and have similar strategies relative to how the system's real estate managers are operating. So a better fit benchmark. Private equity, this is something that over the past couple of years, and this is just actually changing the name of a provider. So that Venture Economics Private Equity Index, that was actually purchased by Cambridge. So Cambridge actually now administers and manages that index. So we just wanted to make sure that was updated to reflect who's properly administering that index. And then on private debt, that was an area that it sort of had a hybrid of different indices in there. And just looking at the structure of what the current private debt managers within the portfolio are doing, they're probably more akin to the Credit Suisse levered loan index. So that's going to be the most appropriate index for the current subset of private debt managers. I'll pause there for any questions. I know that's a bit of a messy table.
That looks great. I appreciate the updates.
Okay, and that so certainly that one, while that looks kind of busy right now, we actually simplified that table quite a bit. So once it's all cleaned up, you'll actually see a much simpler version of that table.
Hey, Jeff, I have a question. This is Justin.
Yes.
The target percentage, should that total 100%?
It should.
So equities are, did you say 28%?
Correct. Domestic equity, 28%, international, 15%, global 5%. And if the math is not correct here, we will get that fixed. Global asset allocation, 3%, fixed income, 25%, hedge funds, 5%, real estate, 7%, private equity, 7%, and private debt, 5%.
Okay.
And again, those should correspond with the table that we presented at the last meeting.
Okay. All right, thanks.
Okay, good question. Okay, let's scroll down to page 15. And again, it just looked like there was some excess language in that title. We're not sure why that was in there, so we're striking that. And the example on this page for duration, we just wanted to update the wording in that example to correspond with the change that we recommended up front regarding the duration of the portfolio. So again, we show that 75% to 125% guideline that we recommend, and then we show that example of how that would work math wise. And then that takes us down to page 16. Again, this one's going to be a little bit messy, but here are those target allocations, not only by the major asset classes, but also the sub asset classes, and then the recommended ranges. So again, these should correspond to the table that we shared and proposed at the last meeting. And if approved, these will be the same percentages that you'll see in the performance report on an ongoing basis. So you'll see these targets and you'll see those ranges on that chart that we show with the triangles that tells us we're in compliance or not. And then scrolling down to the next page, and again, this one will look a little bit messy, and this table actually gets a bit bigger, but again, we wanted to make sure that we were more detailed than what we previously had in this table. So this table previously was lumping a number of different managers and categories together, and may have had some overlap in benchmarks that might not have been the most reflective benchmarks for each specific manager. So what we wanted to do in this table was actually spell out the current managers that are in the portfolio, what that manager's benchmark is, what that manager's universe is, and then we're also showing in that final column what the structure is, whether it's a separate account, a commingled fund, or a mutual fund. So the table gets a little bit bigger because we are delineating everything here. And this is the one that frankly will probably, as far as this investment policy goes on a go-forward basis, would be the thing that changes the most. So whenever we add a manager to the system or terminate a manager from the system, this table would get updated to reflect that. And that table spans a couple of pages down to page 18. And that's it. The final section is the MWBE policy, which we did not make any changes to. And certainly we've had some good discussions over the past couple of meetings about that policy. And we do have a bit of an update as well on a couple of managers that the trustees had some questions on. And so we can address that at the end of our agenda as well. So that concludes the
Jeff,
major.
I had a question on that. Let me find my write-up here that I wrote. I'm now
Sure.
able to pull it up. I'm trying to find what page I'm on. What page is that? It's 20, 17, 18. Hold on.
Wait,
Oh,
we-
it's okay. It's 19. For me, it's 19. So at the bottom, because if you see, this policy has been in effect for 2013. So it's not a new policy. So
Sure.
it's compliance with, and the managers that we really don't add, besides exponents, right? We really haven't added much to our managers on this in the last 8-9 years, especially on equities or whatnot. So on here, is there a way to put at the end? Because it just says performance and relationship with failure by an investment manager to meet the goals set forth in this policy will be considered as a factor in evaluating the investment manager's overall performance and relationship with the fund. I just want to add, and may be terminated.
Sure, we can
Because
certainly.
the big issue is there's no teeth here. It
Right.
just says we're just going to evaluate. It's not going to say you don't comply with this, you will be considered for termination.
Right, we can certainly add that if that's what everyone would like to do. That's an easy add, and it would certainly dovetail and codify our most recent round of correspondence to the managers, because that's the letters that Sue distributed to the managers that were on watch because of this. We're specifically told in that correspondence that it's a potential cause for termination.
Right, because if this is an annual test, then why should we wait an additional year to comply with something so simple? Especially when most of these managers operate in Illinois and, in Texas and New York and all the, and some of these other states that we have these requirements.
Sure, that makes sense, and that's certainly something that's easy enough to add language wise to this document.
So is there proposed language you want us to add here?
I just said, and may be terminated, simple, at the end.
Okay.
Hello?
Hello?
Excuse me. Well, when you say that you're evaluating the investment manager's overall performance and relationship with the fund, well, does that not include termination when you're evaluating?
Right, and I think that's what Christina is trying to get at here, as to just saying that we, in addition to evaluating, this could be a factor that may lead to termination. Is that correct, Christina? Does that sort of encompass what you're looking for here?
Yes.
Okay, well, all I'm saying is in the evaluation process, it would be a termination thing if it doesn't come up to par. That's all. I'm
Right.
just thinking of saying the same thing over and over. That's all.
Sure. Okay, yeah, well, let us add some language to that, and then along with the couple of other things we need to address in the document, we can redistribute.
Okay.
If the only thing is that they've got to have this ready to go for next week. So do we want to?
That's why I'm making the recommend.
Yeah, get
Yeah,
the
I'm making the
language now
recommendation.
and get them to
Yeah.
vote on it.
Oh, okay.
So would that require a motion?
No, it doesn't require a motion because we're going to make a motion on all of the proposed changes at once.
Okay, we just need to put the language in there then.
Yes.
Yeah, okay, gotcha.
Okay, so we'll turn that around. We'll turn that around quickly. And other than that, are there any other questions, comments, discussion?
I have a question on number one on that Appendix 4, minority and women-owned. What is a step-out trade? It says step-out, sentence number 1, the last, step-out trades will not be counted towards trades with minority and women-owned business enterprises. What's a step-out trade?
Yeah, so that's essentially just that's a trade that they're basically handing over to another firm that's not their firm. So it's kind of like it's almost like using a sub-advisor to do your trades.
Okay.
And again, I think why that gets spelled, why a policy like that will typically spell that out is because that's harder to track. And frankly, they're probably, I think with a lot of these mandates, are going to be fewer and far between.
Okay. All right. Thanks.
So is there any other discussions on the guidelines? Sorry. Hearing none, can I get a motion for number 2? Up on your screen?
Is that to be done at the general meeting?
Yeah, we'll do a recommendation here.
Yeah.
And then it'll be, we'll have a bunch of motions from the investment committee to be finalized at the regular board meeting.
Correct.
Then, I wouldn't use the phrase to accept. I think it might be better to say to recommend to the general body.
Well, so the managers propose to us and we accept the revised investment guidelines as recommended by ANCO. And then when we say yes, then it goes to the general meeting that says it has been recommended by the investment committee to approve the revised investment guidelines. Then we approve them at the general meeting as a recommendation from committee like we do everything else.
I'm still not comfortable with that because it's to me, with all of us present here, we have 8 members here present. We're accepting the guidelines. And I think that it might be better worded if we said we recommend this recommendations and not.
So
It might be a matter of semantics here, but to me, by saying, yes.
No, I just said you don't have to accept them if you choose to vote no. You can say no, you don't accept them. That's fine. But that's why we make a motion and then we get to vote.
We've done this we do this for even for an investment decision. We accept the recommendations so Sheila, you're just wanting to add to accept the recommendations for the revised investment guidelines. You just want to include recommendations in Sue's proposal.
No, I don't want to accept that. We recommend. When we vote on it, then we're accepting it.
So when we go to the
it might be a matter of semantics.
Yeah, when we go to the general meeting, we don't go into discussion in details and debate what came out of committee. We either accept or decline the recommendation from a committee.
Oh, no, you have to discuss it.
There's discussion.
Whatever motion is made, we always have discussion or questions.
Yes, we do have those, but we don't re-deliberate anything that was discussed.
No, we're not going to do that.
Okay.
No, we won't be doing that. Go ahead on, do your thing.
I make a motion to accept the revised investment guideline. I make a motion to accept the recommended revised investment guidelines as recommended by ANCO.
I second.
You said recommended, but that's not what's on the paper here.
What Sue puts on there is just a guideline for us.
Yeah, it's just to help. Yeah, it certainly can be changed at the pleasure of the trustees.
Correct. So it's been properly moved and second. Is there any discussion? Hearing none. Sue, can I get a roll call vote?
Christina Bennett,
Yes.
Lewis Cross. Dropped. Sheila Goodwin,
No.
Yvette Levy,
Yes.
Martel Mann,
Yes.
Bobby Richardson,
Yes.
Albert Sanders,
Yes.
Justin Stein,
Yes, sorry.
Doris Walker.
Yes.
All right. So we do have 7, so the motion carries.
Thank you for that lengthy discussion and review of our guidelines. It was much needed. Are we going to quickly go into the investment report?
Yes.
Thank you.
Sue, if you can bring up the flash report onto the screen. Okay, turn to the first page. Good evening, everybody, again. I will briefly kind of frame the discussion for the fund based upon what happened in the markets in the month of May. And bring it, actually, my first comments are going to be of what's something that's more recent. As you know, inflation has been top of mind and has affected the markets, which have been very volatile over the last few months. As you know, the Fed raised interest rates by 75 basis points yesterday, and we're anticipating continual raises in the rest of the year. There was they underestimated the effect of inflation. They thought it would be more short term, but it looks like it's more long term. And as a result, we've seen a lot of volatility in the markets. Yesterday, the market actually reacted positively, but today we saw a huge drop again. The Dow's down over 741 points today, and it's now below 30,000. The S&P's down today. The NASDAQ is down today. The actual oil actually has gone up. It's at $117 a barrel. So that's one of the highest levels that it has been. So, you know, we're seeing this inflation every day at the grocery stores, at the gas pump. And the concern now is we may be slipping into what a lot of you've heard is a mild recessionary environment, or really more appropriate stagflation. The one element that's missing in the stagflation discussion, typically that means that you've got low growth, high inflation, high unemployment. Unemployment is still low. Unemployment nationwide is about 3.6%. So we've got a really weird situation going on here, and the Fed has to be very careful about the raising of interest rates because we don't want to stall the economy out and go into a real recession. So it's a very, very, very delicate balancing point. As you can see here on this page, you see the markets up at the upper left-hand corner, the equity markets right below the fixed income markets in the month of May. As you can see here, that first column, the S&P, they all eked out slightly positive returns with the exception of the Russell 1000 Growth Index. And as a result, the Russell 3000 has Russell 1000 Growth as part of it, has a slightly negative. But as you can see here, there were slightly positive returns with the best performance in the Russell 1000 Value Index at a positive 1.94%. You also see that the international markets represented by the EFA index at 0.75 actually did better than most of the domestic equity markets, with the exception of the value component. If you look over to the right, those colored bars over there, you see the different style indices for year to date and as for 2021. As you can see here, year to date, where we had growth was really well a year ago. Now you see growth across all capitalizations, large, mid, and small, is significantly more down than the value indices, which are the green, large, mid, and small. They're down single digits, whereas the growth indices by capitalization are down double digits, significant double digits. If you drop down to the fixed income portion right below on the left-hand side, you see the aggregate, which represents the broad US fixed income markets at a positive return of 0.64. All those are positive. But if you look over a little bit further over, as you can see, fixed income also has been hurt significantly for the 3-month period as well as year to date, which is showing negative numbers. So there really wasn't really anywhere to hide. The one thing I'll have you turn your attention to, if you're looking over to the right-hand side again, under commodities, you can see the different change in the different commodities over the course of the last couple of years, 2.5 years. And you can see here where I was talking about oil. Here it's showing 114 as of 5/31, but as of today, it's up to 117. So the commodities have increased, whereas the general markets that we invest in are on a year-to-date basis are all down. So that kind of frames the discussion for your actual fund. So if you can turn to the next page, Sue. This is the chart that that was referenced by Jeff earlier. all segments. The gray bars represent your ranges. The little triangles, inverted triangles, represent where your fund is with respect to those targets, which is a black line in the middle. As you can see here, all of your segments are in sync or are within the ranges. Cash is a little under, which that changes depending on the flow of money in and out for benefit payments and expenses. If you look down at the bottom here, you see the target allocation in the middle of the page, and then you see the current allocation, and the difference from the target to the current is the difference column. As you can see here, not unexpectedly, as you can see, based on what's happened in the markets, the total international and total emerging markets are the two areas that have the most deviation from their targets, are the most under, but not significantly so, at 2.1 for international equity and 2.6 below for emerging markets equity. And your large cap domestic equity is up 2.2%. But the most important thing is you're still within your ranges, so that determines your long-term returns of the fund. So we're good with respect to that. Any questions on the markets or the asset allocation before we move over to the next page? Page 3. So if you can move to page 3. Okay, there we go. Okay, so here is the returns of the your actual fund in the month of May. As you can see here, actually you eked out positive returns for the total composite at 0.49 versus 0.07. And on a fiscal year to date, the total fund was protected compared to the policy index, albeit negative, but less negative than if you were invested totally in passive indices. And the 1-year number is also that with a less negative number than the policy index. As you go down the page, you can see here that your total domestic equity actually has added value here. The Russell 3000 had a negative return of negative 0.13. And for the month of May, your domestic equity managers as a group outperformed at a 0.48%. For the month of May. If you go down a little further, this dissects it even further as far as the different types of domestic equity managers. The stock index did what it was supposed to do. The Mellon Equity Stock Index did what it was supposed to do. It matches the S&P 500. Edgar Lomax was your best performing domestic equity manager. As you can see here, Edgar Lomax returned 3.17% versus 1.94 for the index. And this has also given them a fiscal year to date and a 1-year return significantly above what the Russell 1000 Value Index has delivered. The next two managers below that are Intech and TCW. Those are both large cap growth managers. As you can see, Intech protected, albeit negative, on the downside in the month of May, the negative 1.96 versus the Russell 1000 growth at a negative 2.32. The fiscal year to date and the 1-year numbers are a little bit more challenged there. Both Intech and TCW have felt the effects of this reversal in style. And as you can see here, TCW actually underperformed the Russell 1000 growth at a negative 2.9 versus a negative 2.32. And that follows through for the fiscal year to date and the 1-year numbers. Next page. In the next segment, which is your small cap portion of the fund, as you can see here, actually they held up actually pretty well. If you look at your three managers, Westfield was the only one that had a negative return for the month of May, with a negative 2.13 versus a negative 1.89 for the Russell 1000 Growth Index. Systematic just slightly off, but a positive return at 1.87 versus 1.92 for the Russell 2000 Value. And the most value add in this segment was in the DFA US microcap portfolio, with a return of 1.78 versus a negative 0.12 for their benchmark. And if you look at these managers on a relative basis compared to their benchmarks on the fiscal year to date, Westfield is has delivered over and above what the Russell 2000 growth would have given to you. Systematic is below, and the DFA US microcap portfolio has protected on the downside fiscal year to date. All of them on a 1-year number ending May 31st actually have protected in a very difficult market, and protected and giving you more return than the indices would have given you. The next segment in equities is your international equity managers. And as I mentioned earlier, EFA actually was one of the positive areas, and actually EFA did better than most of the domestic equity markets in the month of May. And as you can see here, both of your managers, both Fidelity and Causeway, delivered excess returns over and above the EFA, with the Fidelity returning 2.4 versus 0.75, and Causeway doing really well at 3.91 versus 0.75. On a fiscal year to date, Fidelity is more challenged and has underperformed the EFA for the fiscal year to date in the 1-year number, whereas Causeway actually has protected in a difficult equity market with a negative 0.54 fiscal year to date versus 11.34 for the EFA, and the 1-year number negative 8.55 versus negative 10.38. Next one down, in what has been a tremendous hard time for emerging markets, actually you see positive returns here in the month of May for both DFA and Invesco. DFA actually outperformed 0.61 versus 0.44, and the Invesco emerging markets equity portfolio, which has had a really tough time, if you remember from previous months, actually performed at 2.27 versus 0.44. On a fiscal year-to-date basis, though, the DFA emerging markets portfolio has delivered excess performance versus the index, both fiscal year and 1 year, whereas you had tougher performance. If you remember, there was more exposure to the some of the affected countries from the Ukraine-Russia conflict in the Invesco emerging markets, and that's reflected here in their fiscal year-to-date and their 1-year numbers. So you can turn to the next page. And here you've got your manager of managed Exponents, your global equity manager. As you can see, Exponents has outperformed their benchmark, the MSCI World, with a return of 0.69 versus 0.08. So that manager is held up. And on the fiscal year-to-date basis, they're ahead of the MSCI World Index, 1 year below. You can see the different components below the Exponents manager of managers, with Foresight and Arga actually delivering a positive, the most positive performance in the month of May. Next page. Any questions on the equity before we turn to the fixed income? Okay. And fixed income, actually had for total fixed income, it's slightly below the Bloomberg Barclays or the Bloomberg US Aggregate Index, slightly below at negative 0.17 versus the aggregate at 0.64. If you drill down looking at the core managers, Manulife just a slightly positive return, 0.05, and it underperformed. Ernest Partners, positive return, but underperformed the Bloomberg aggregate. But Exponents, which is a manager a little bit different, actually delivered most of the return in the core segment for the month of May at a return of 1.31 versus 0.64 for the ag. If you look at the fiscal year to date, you'll see here that Manulife is below. Ernest Partners is right on top of it, just slightly better than the ag, and the Exponents portfolio is below. The next segment is your absolute return fixed income manager, Lumen Sales. That manager has delivered slightly negative returns for the month of May. The fiscal year to date and the 1 year numbers are negative. We'll have more insights in that when we do the quarterly report. The TIPS, which is just a replication of the index, has done what it's supposed to do. Neuberger Berman, global opportunistic fixed income at a negative 0.53 for the month, as well as they have underperformed for fiscal year to date, and the 1 year numbers are below the 3-month LIBOR plus 3%. Emerging market debt manager Lazard had a difficult month, negative 0.10, not real bad, but slightly negative versus its blended benchmark at 0.55. But on a fiscal year to date and a 1 year number, they protected on the downside and outperformed that blended benchmark. Next page. And here are your global TAA managers, GMO and PIMCO. As you can see here, GMO actually delivered in the month of May with a return of 1.61 versus 0.27 for their blended benchmark. This actually brought their fiscal year-to-date number on a relative basis above the blended benchmark. The one-year numbers are still a little off. The PIMCO All Asset Fund actually did not return as much as their benchmark in the month of May. But if you look on the fiscal year-to-date basis and the one-year basis, they have outperformed their respective benchmarks. The next section is your hedge fund managers. As you can see here, your hedge fund managers, the two that did well on a relative basis in the month of May were Entrust and Whitebox. Both of them delivering excess returns over and above their respective indices. Grosvenor had a tougher time with a return of negative 2.09 versus negative 0.60. If you look at the fiscal year-to-date numbers, your winner here for fiscal year-to-date as well as for the one-year number, if you look at that, Whitebox has really delivered with a return of 6.01 versus negative 0.50, and the one-year number ending May 31st, 10.96 versus a negative 0.17. If you look at all three of them on a one-year basis, they all have delivered returns in excess of their respective benchmarks for the 1 year ending May 31st. Next page. I believe the next page may be, okay, the privates, they have not reported yet. And we will have, once those report, you'll get updates on these different segments, real estate, private equity, private debt, we'll get updates there. Any questions on the performance of individual managers before we make some comments on, let me go on to the next page. I want to get to the brokerage before we end the meeting though. Any questions on performance before we go to the reconciliation?
Have we received any private market updates this year?
We have gotten some, but they're not all up to date. And
So
actually, what we're going to
March numbers yet?
No, the March numbers, more than likely, what typically happens, Christina, what we have seen with the privates is there's typically a 6-month lag. So the next numbers we'll get in June, the numbers that we'll report in June typically will be the 12/31 numbers. And it takes a while for us. And what we're going to do and what we're starting to do in the financial reconciliation is we will be noting which ones are up to date and which ones are lagged. That's something that we're going to add to the report. So you know which managers are up to date and which ones are lagged.
Okay, thanks.
Okay. You can go to the next page. Actually, go down 2 pages to the end of the rec. Okay, there, right there. Okay, so as you can see here, the market value of the fund at the beginning of beginning of May was 859,345,739. You see the net internal transfers, the contributions, the distributions, and the capital gain or loss. You've got a net capital gain. And so with the amount of distributions that came out, you see that the ending market value as of the end of May was 852,154,472. And we've added some columns that makes it a little bit easier to actually add the numbers across going forward. Next page. Oh, this is okay. This is just the asset allocation. So the other things that we wanted to address, if there are no questions on the report, we wanted to follow up on some things that were discussed at the last meeting. Jeff alluded to them in his discussion. We've had conversations with both Intech and TCW. Actually, based on the conversation we have with Intech, Jeff and I both feel like they're going to have a more difficult time meeting the brokerage requirements because of how they trade. They do a lot of program block trades. So we really don't think that Intech will be able to meet the 33% target for trading with MWDBE brokerage. Now TCW actually we gave them some names of some firms that they could look to, and they've actually added a minority brokerage firm, Loop Capital, and that's been vetted. And what they would like is to be given consideration for looking at them over the course of the year, inclusive of the third and fourth quarter, before we make a determination. They think they can meet the target by for the, the target is for the year is 33%. With them adding on that brokerage firm, they feel like they can meet the requirements as outlined in the investment policy. We did send a per the vote of the board, we did send a letter to, or had Sue send a letter to Intech, and we also had the letter sent to Exponence regarding the loss of the primary portfolio manager in that fixed income portfolio. Are any questions?
Just to clarify, Gwelda, the letters haven't been sent yet because
Okay.
the full board action.
Okay.
After we do that vote and the board would approve those recommendations from the investment committee, then we can send those letters.
Okay, I stand corrected. So we did have the discussions though with TCW and Intech, and we're keeping our fingers crossed. But we think TCW, they're really committed to try to meet your percentages as outlined in the investment policy regarding NWDBE brokerage. Jeff, you want to add anything to that?
Sorry, I'm on mute. No, that's that's a good summary. I think bottom line, good news from TCW that they are going to comply and have added a brokerage. And I think Intech is just something we'll have to continue to think about in terms of that it's already a manager we have on watch for performance and organizational issues. And I think this is probably just something else that certainly puts it over the top. That while they told us that, and they asked us to send them a brokerage list, and so we gave them a very long list of brokers as well. So they told us they would outreach, but I think at the end of the day, because of how they do everything in a very systematic and almost commingled fashion across all of their different accounts, that's probably going to represent a fairly sizable change for them to dig in and get it done. So as Gwelda said, that one's probably much further down the road.
So Jeff, you mean to tell me that they do not operate in New York or in Illinois?
Now TCW, Gwelda, correct me if I'm wrong, came back and told us that actually they did not have any Illinois accounts. Intech has said they're still checking in on that for us. So we never got a response from Intech on that. So again, now here's also a bit of a difference, and this is something we found out in talking to some of the managers too, and Gwelda and I did a little bit of background work with some other plans too, but the Illinois requirement is actually ends up being a total percentage requirement as opposed to a by manager. So they'll say what percentage of your total trades if you aggregate all managers, and does it meet the requirement? So that's how Illinois is looking at it, as opposed to on a manager by manager basis. So that tends to be another difference. So I think someone like Intech could very well be doing business in Illinois, but if they're part of a portfolio that has other managers that are helping to meet the requirement, then they're not getting scrutinized as much.
I was going to say one thing, you may be also that the state requirement may be one thing, but some of the individual funds, the pension funds, may have a higher requirement, because I know for a fact that some of them do have a higher requirement than what the state is asking for with respect to NWDBE brokerage, having experienced that with some prior clients.
Right, and I don't
Chicago.
believe that Missouri will implement anything anytime soon. I like the recommendation. They should also go to, do you do any business with Stern Brothers?
Actually, I've been contacted by Stern Brothers, and what I told him was that we as a firm, he has had some, done some trading with some of our other clients, with some of our consultants in other offices. And I did speak with him, and I told him that everything as far as the managers are on the company, on the website for St. Louis Public Schools, and that he could reach out to them to ask for trades or talk about trades with them and let them vet them. So I did tell him to go ahead. I had a couple of conversations with Reginald Scanterbury regarding.
Yeah, because I sent them your way because that's not, you know, that's not where I'm going to have discussions.
Right.
So we as a fund do not have an authorized approved list.
Right.
We have recommendations, right? So, I mean, I like the fact that, you know, I did, that we did recommend Loop. Loop is expanding their breadth and depth and what they're doing. So, you know, if they can get up to speed with Loop, that would be great. I mean, I guess on a going forward basis, when we do interview managers, that we make sure that, you know, in the RFP that it is stated up front.
Right.
That don't, you know, if you cannot comply with this, don't even respond. We don't even do RFPs, right? So we do the recommendations, I guess, from the consultants is to not put a manager in front of us that
right.
We, you know, we have to deal with this.
And that's something that Jeff and I have already, I know there was some discussion about us looking at some large cap growth managers. And that's one of the things that we're going to put in the qualifier in our when we start looking, is that the manager has to be able to comply with that trading requirement. So if they can't comply, then they won't even be brought to the committee.
So what is your recommendation for today?
We don't have a recommendation for today. I think that we've we've already done that at the last meeting with the recommendation to put Intech on watch and to put Exponence on watch. And we did the follow-up with TCW. So with TCW, I think Jeff and I would both say, let's give them the next 2 quarters. The third quarters, we're almost through 3/4 of the way through the second quarter. Let's give them the third quarter and the fourth quarter and reevaluate TCW on an annual basis to see if they have met that 33% requirement. So that's where we are. Jeff, anything to add?
No, I think that's fair. So I think TCW is, I think there's just, they're trying, they know this is serious, and let's let them get in line, but we have no reason to believe that they won't. Intech, I would say, again, we're not ready to today say let's go ahead and terminate based on this, but I think what we would say is let's give them a little bit more time to see if they do respond and what they're doing with this list that we provided them. Likely not much, but I would say fairly short leash, and then I think over the next month or so we can come back and readdress and say, we just don't think it's going to happen. And certainly if performance continues to be an issue with them, then we would probably be in a position to say, let's either look for a replacement or think about a search, or at least temporarily thinking about terminating them and putting them in the index. So that not something that
sounds good. Now,
okay.
I don't know what their percentage was at the end of the year. However,
I don't think they reported. I don't think Intech reported.
Is it something where you would recommend, or we would consider, like, hey, if they can only do 10%, 20%, whatever the lower number is, that we would keep them to ensure, because given their trading is very different. You know, that's something we could consider if they can, but if they're going to say we can't meet it at all, I don't know what their numbers were if they were at 0.
They didn't report. They didn't even report.
Yeah. And so maybe that'll be our next step, at least with Intech, is to again reissue our spreadsheet to them that says please report this to us. And we at least want a response from them. If they come back and say we're not doing anything, then we're 0, then we at least know that. But again, if they come back and they don't even respond to our questionnaire, then that's kind of another level of just saying, hey, there's something you don't want to tell us, it's not important, then we're going to factor that into our decision making.
Okay. Do we have anything else, Gwilda?
No, that is it, unless you have some questions or requests of Jeff and I.
Who knows what rates will be like on Tuesday?
Oh my gosh. Don't look at your retirement accounts.
No, But if you're fixed income, right? I mean, I guess on some, you know,
It just depends on how, where you're allocated, but it's not pretty right now. It's not.
Yeah. Well, short term it hurts, but ultimately for fixed income, it's giving everything now that all bonds that are now being issued are now getting higher coupon rates. So eventually it's good and works out, but there is short term pain we have to deal with.
Yeah. The good thing about it is the fund is allocated well and it will come back. The biggest thing is I tell people, do not sell your personal portfolios, because then you're realizing a loss. Think of it as buying a pair of shoes on sale. Buy more.
The markets are very volatile at the moment.
Yeah, they are.
Does any other trustees have any questions for Jeff and Gwelda? Hearing none, can I get a motion to adjourn?
And Christina, before we do that, just clarifying, we don't have a meeting in July. We don't have one on the calendar, so just wanted to clarify.
I need a break.
Yeah. We have one for August. We have some stuff on the agenda for August, but we didn't have anything for July.
Yeah, no, unless anybody else opposes to not having a meeting in July.
Well, we're celebrating Juneteenth on Monday.
Not on the schedule, is it?
No, it's not on the schedule.
Okay, yeah.
Not because we're going to Lake of the Ozarks in July.
I was going to say,
That's true.
Maypers is usually around that same time.
Yeah,
So-
Maypers is the 13th through the 15th.
13th through 15th.
And who is attending, if anybody here is attending the NCTR?
Yeah, I am.
Berkeley?
Berkeley, yes.
Yeah, I'm going.
No,
Mm.
no, I'm not.
You're not
Well,
going, Sheila?
No, I'm not. I'm going to NASP.
Okay.
I'll see you at NASP's good one.
I'll be
Okay,
at
great.
NASP next week. I'll be at
see you there
NASP.
as well.
And,
Me too.
but if you're going to Berkeley, please let Sue know immediately.
I
And
think I
two-
did let Sue know, but I'll let her know again.
Okay,
I
and
do-
two,
I-
if you haven't booked your airfare, better book it now because they've just
It's
gone through.
going
the
up.
roof.
Yeah. Okay. Will do.
And
Oh.
I was late to NASP and got kicked to the curb and don't have a hotel.
Oh,
So-
no.
Mm-mm.
Me too. Me too.
Oh, you're
No,
going to,
Bobby-
I'll see you, Ms. Richards. I'll see you there as well. What'd you say, Christina?
Bobby, you don't have a hotel?
No, when I called and made a reservation, he called me back 5 minutes later and said, "I'm sorry, they didn't have any more."
Well, Bobby, if you want, you can stay with me if you want, because I'm not around the corner, I'm across the bridge. So, yeah, if you want to stay with me, you can.
But thank you, but Sheila offered me to stay also.
Oh, see, but you know what? She's gonna be at the hotel. I'm not. All righty. Thank you, everyone. Oh,
Forget
Okay.
everybody.
need to
Monday
take a
is
vote.
Juneteenth.
All right.
Yes.
See y'all on the 23rd.
Okay, I'm
All
sorry.
right.
I interrupted the motion, so we do have to officially
Is there-
do the motion to
is there a
adjourn.
Sheila Goodman makes a motion that we call the meeting to an end.
Second.
Adjourn.
is there a second?
Second.
It's been properly moved and second. All those in favor, please say aye.
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 Have a great weekend, everyone.
Thanks. Take
Okay.
care.
Everybody have a
All
good one. Thanks.
Bye.